A lot of people are, including Mr. Rosenberg, are talking about how January was bang up and we're already into our economic slowdown. We hear that within the guidance of corporate earnings, selected guidance, I should say. Are we into our slowdown?
We're still in a slower growth environment. And I say that only because remember that outside of the pandemic boom or post-pandemic boom, our potential growth rate is around 1 3/4. I think that's where we're settling, 1.5 in the second quarter. And the consumer still has so much momentum behind it. You look at the fact that yes, the wealth drawdown, the savings drawdown continues, but I think if we've seen anything, it's that deposit levels broadly are still relatively high. And that means that with jobs still broadly plentiful, outside of tech, I want to be clear, there have been some distressing layoff announcements, but jobs remain plentiful. It's what we're looking at the most closely, but right now it's way too soon to call for a recession.
This idea of a recession, if I get a growth rate, and I want you to give me your growth rate for it, if it's under 2%, to me that's germane. If we have a 1% or 1.4% all bundled in growth rate, isn't that a recession for a lot of Americans?
It doesn't feel good. One of the big conversations that we're having is the fact that we're seeing sluggish growth rates, but still really significant and robust job ads. And most of those new jobs are going to still these sort of lower productivity service sector jobs. I think productivity is extremely low right now. And that's what makes it feel like such a grind. But this is really the difference between sluggish growth. We've had plenty of periods. Remember 2015, 16, we basically had an earnings recession, but we didn't have a growth recession. You get periods of sluggish growth that don't check all the boxes of recession. It doesn't mean they're great, and it doesn't mean that they're easy investing landscapes. I think you bring up a really important point about the forward guidance we're getting from companies. Earnings estimates going forward are still flat. I mean, they've come down a lot, but the forward 12-month is still at net flat. That's not a recessionary outlook. In recessions, earnings historically fall 10% at least.
I'm struck by everyone talking about this bifurcation or just splintering in terms of the fates of different sectors. And you were kind of, before we got on air, talking about this as an 18-wheeler and the Fed's just pumping the brakes on 2 of the wheels and then everything else keeps grinding along. And I wonder if we're going to look back, yes, as a grind when it comes to just growth numbers overall, but a real transition moment for this economy where it sort of accelerates the gap between the haves and the have-nots, whether it's individuals or whether it's companies, the large ones with pricing power, those that are going to get subsumed or go out of business. How much are we at a tipping point that will rearrange the structure of this economy?
I think, Elisa, I think we're already there. I think if you look at the share of capital going to labor, it's actually already increased. We've already seen globalization really wipe that out significantly, and we've bounced pretty significantly. I think when you look at the breadth of the market rally that we've seen, it's so narrow, and it's so narrowly focused on these large cap tech companies. It makes the pressure on the earnings this coming week very acute. And I think beyond that, look at the whole issue that the Fed is having with inflation. The wages that the historically sort of commoditized service industry is able to garner is really rising. It's not necessarily good for profits going forward, but I think we have to acknowledge that maybe we had kind of stretched the rubber band of inequality so much that it is rebounding to some degree. I don't think that's all bad.
The creative destruction, Lisa, I thought your question was just brilliant. Let's go back a few years, think 1982, 1970, Dow Jones Industrial Average, the Westinghouse Electric Corporation, a company called Eastman Kodak Company, Union Carbide, Inco Limited, and others, Goodyear Tire. I mean, I think what you brilliantly asked about in the superiority of technology is just American corporate history. It's just that simple.
I would agree. And pair that with the sort of right sizing of imbalances that have been created over all of this time. Lara, you mentioned how a lot of lower wage workers kind of getting more power in a sense, that the power is shifting back to labor to demand more for their services. sources. We got the results from McDonald's. We got the results from PepsiCo and Coca-Cola. And we can see that actually they are still able to pass along the price increases to consumers. How much is this a story that runs out of time? And how much is this possible because of that power of labor, a basic stickiness to an ability to pay more?
Well, and I think add on to that the fact that when we look at these companies, the big tech companies right now, they're growing by expanding into each other's lanes for the first time in a long while. They're very mature companies. And, unlike before where it was only focused on growth, I think now they're having to kind of cannibalize each other as they grow. And, Lisa, to your point, the data point this week that I think is garnering so much attention for me is initial claims. We've seen the tech layoffs. Let's see how it expands to the broader economy. Because right now, I hear companies we're still working to retain labor, not just blanket looking to shed.
Lara, more than any other chief U.S. economist I know, you've enjoyed the trenches of foreign exchange study. How does a dollar fit into the dynamics to 2024? A weak dollar, strong dollar? Do we overestimate dollar movement?
I think a lot of people right now are watching closely to see if the dollar weakens further from here. It's weakened significantly over the last year, but still, if you look at a long run view, it's relatively strong. I think that the humdrum around the dollar's weaker status as a reserve currency is getting a lot of attention. And to me, that's one of the unspoken background stories of the strategic chess match, which is going on right now globally.
So what is your run rate for GDP? I mean, 12 months out, all in GDP. I think it's something our audience, with all the narratives Lisa's talked about, we've really lost scale of. What is your statistic for real GDP out 12 months?
1% growth over entirety of 2023. I think we hit negative 0.5% in the third quarter, negative 1.5% in the first quarter, and then we bounce from there. I think it is a recession, but I do think it is more mild, and that's because these big companies are needing to invest.
When you talk about some of the larger companies cannibalizing from each other, do you think that we're going to get, I know that Tom always talks about monopsony, are we going to get basically oligarchies in every industry? Is that going to be how we emerge from this period?
I mean, I think you could argue that we're already there, but it is something that America does well. It's destroy our oligarchs. I think, I remember 15 years ago, we just talked about Walmart and how every single earnings cycle, they just got bigger and bigger and bigger. And then Amazon came along. I mean, look back at history. It's rife with companies that really expand and blow our minds with innovation. And then 20 years later, they've been toppled by the next new thing. So, are these the companies that are able to innovate and stay ahead of that? I think they're great companies. I just think that they're trading at their PE ratios are too high right now.
So as Tom mentioned, I've been a little bit all over the place today. I've been really interested in a number of different themes. And we keep going back to the one that's underpinning so much of what's going on economically, which is inflation. And we kind of hinted at it with respect to labor's power. And when is that going to wane? When we emerge from this, will it be to a higher inflationary regime based on that shift back to labor?
I'm going to add more nuance and say that I think we end the year with inflation that's uncomfortably high, around 4%. But I do think that, of course, we will face periods of lower inflation. I think that the 25-year low inflation, low volatility inflation episode is over. And going forward, we're in a period of higher volatility inflation, less ability to control inflation through globalization. And I think it implies more volatile monetary policy cycles.